as promised, with lots of great advice, and we're going to unpack some things for our viewers right now. Phil Bloyd is returning with us, expert from Revolutionary Financial Group. And gosh, it's nice to have you.
Good to be back.
You know, we've got a lot of questions.
Sure.
In fact, Phil, folks who are watching this show sometimes ask me questions, and I'd love for you to help kind of simplify some of this. You know,
Sure.
when you're working, and a lot of our viewers are in retirement, but you know when you're working that most of your savings is going into 401k of some
Right.
kind. You might have a match, you may not, but let's work through the two different types. There's a Roth 401k, and then there's a traditional 401k, and same for IRAs. So
Right.
demystify this for us between a Roth IRA, a traditional IRA. What are the difference between these
401ks.
four items?
Yeah, and 401ks.
Yeah.
So most employers now offer Roth 401ks.
Yes.
So as I'm contributing into this 401k or IRA, well, same thing, well, different, but let's just say, in a Roth 401k, as I am contributing, I will not deduct that from my income tax.
Okay, right.
So people say, well, it's saving me tax money. Not really. You're just deferring the taxes
Right,
for later.
so you're
time.
not paying it now. You're kicking the can
Yeah.
down the road.
We call it tax deferral.
Yes.
Not tax free. Okay.
Okay.
In a Roth, as I'm making the contribution, I don't deduct it or defer it. But the gain that comes on top of that is going to grow. There's some rules involved, okay? We don't have time to get into all those.
Okay.
But technically, the gain that I'm getting from the investments over time, when I take that out, I won't pay any taxes on that,
Okay, so
Okay.
on the gains.
on anything.
On anything.
Because I didn't deduct the contribution, see?
I got it.
Now, if I
Okay.
do a regular 401k, we call that pre-tax or tax deferral. All of that's just building a balance that you're going to have to satisfy with Uncle Sam later,
Yeah.
at whatever their conditions are later.
Okay.
So, you know, in most situations, I prefer the Roth because you know, in a growing stock market, wow, that's really going to work to your benefit. If I defer those, that growing stock market is just going to mean that when Uncle Sam decides they want their money, I'm going to have to pay them dollar for dollar on whatever I take out of that thing.
Okay.
Okay.
Well, let's just ask the blanket question then. How can we make our retirement savings the most, or at least more tax efficient?
Tax efficiency. Okay. Great opportunity, great question. Right now, if you have an equity portfolio, meaning a growth or it's stock oriented or growth fund oriented, you know, it's been beaten down probably 20, 25, 30% or more.
Yeah.
So the thing we might consider for tax efficiency is let's go ahead and look at our return and see if we can go ahead and do some conversions now while the asset is in a lower taxable stage,
Right.
but move it over or convert it over to that Roth from the traditional, so that as it grows back, that we've already kind of settled our taxes.
You've done that. You've
Yeah.
paid Uncle Sam
Yeah, right,
at a time
right.
where the rate was lower.
Right.
It's such an interesting strategy, and
Sure.
I've learned that on this show, something that is a sort of counterintuitive to me and maybe some of our viewers. Just go ahead, pay the taxes now.
Yeah, we know what they are now.
Right, there's no question
And we're in a
marks.
lower income tax rates now through 2025, then they sunset, and we're not sure exactly
Right.
what that's going to look
Right.
like. But I have people that come to me all the time, Jessa, they're like, well, you know, my last financial advisor didn't ask to see my tax return, so why did you?
Right.
And I'm like, well, I'm a fiduciary, so the thing I want to, if I'm working for you, it makes sense to me that I want to know how much taxes you're paying on your Social Security. I want to know, hey, would it make sense in your at your tax rates to go ahead and do some Roth conversions? Okay. The other thing, do I have any capital loss carry forward that I could use to your benefit when we're doing a distribution plan for you? You know, so if I'm not looking at that, or I say, well, hey, you know, you asked me an investment tax question, and I say send your CPA, and your CPA says, well, it's what your investment guy is doing is messing up your taxes or whatever. I want to look at the document document itself. Then I can work with your accountant or whoever it may be, or you could be your own accountant. But
So how can
very
you
important.
see if we're being tax efficient if you don't know exactly what those taxes look like on the returns?
When I look at your tax returns, it will tell me a lot about you.
So you need that information.
It's
Yes.
very important, and it's for you so that when we're setting up a distribution plan, we went over the buckets in previous programs. We need to know what is the most tax efficient way for you to take withdrawals to supplement your retirement.
Okay, sounds good. So you can actually take advantage of a tax analysis. There's no obligation. So if this might sound like something you want to do, if you have $500,000 in investable assets, go ahead and call it, get this taken care of.
And one thing, we'll look and see if you have an IRA to Roth conversion strategy. And if it makes sense, the team will do an analysis for you on it.
I think that's great. Well, no time like the present. We're gathering documents anyways for tax time, so it's a good time to take a look. And it's a good time to stick around because we've got a whole half of a show left after
Going
the break.
fast.
Be right back.